you're a UK homeowner staring down a remortgage right now, you know the anxiety of doing so. Inflation expectations are spiking again thanks to ongoing tension in the Middle East. Mortgage market is holding its breath. Prices are looking very uncertain. Today, my co-host Chris is right in the firing line of this remortgage. His ultimate dilemma: does he lock in the security of a 2-year fix or ride out the uncertainty on a temporary tracker? It's a big decision, and today I'm going to help him think it through. Mouthy Money is proud to partner with Coinbase. If you're thinking about getting into crypto, but not sure where to start, consider Coinbase. In just a few taps, you could buy, sell, and hold Bitcoin, Ethereum, and a range of other popular crypto assets, all from right here in the UK. Coinbase is registered with the FCA in the UK, and with world-class security, you can invest with confidence. Whether you're brand new or already building your portfolio, Coinbase gives you simple tools for crypto investing. Join millions already using Coinbase. Download the app today and start your crypto journey. Find out more in the summary. Remember, don't invest unless you're prepared to lose all the money you invest. This is a high-risk investment, and you should not expect to be protected if something goes wrong. This is not investment advice, and it is not a recommendation to buy or sell any particular digital asset. Let's get right into it. I am Edmund Greaves, the editor of Mouthy Money. Welcome to the podcast. Chris, hello. How are you doing?
Nervous, Ed. Nervous, confused. No, I'm overstating it. Yeah, it's on my mind. I'm right in the midst of it, as you say.
Yeah. So talk me through it. Look, we've discussed this on past episodes. You've had this remortgage coming for a little while. I've got one coming up a little bit later next year, so I'm perhaps sitting a little bit more certainty, but there is a lot of uncertainty in the market. Now, the reason why this is happening is because we had the crisis kick off in the Middle East. That sent kind of inflation expectations, interest rate expectations from the Bank of England higher. It re-injected a lot of the uncertainty that we saw back in 2022, 23, when inflation really kicked off, and that sent mortgage rates soaring because the Bank of England had to hike its base rate. Chris, where does this leave you today? What is actually happening?
So my mortgage is up in October. I fixed for 2 years at not an eye-wateringly high rate, but higher than I would like. I think I've mentioned that before. With the idea that the received logic was that inflation was going to start coming down. No one was going to do anything too outlandish from a geopolitical standpoint, and that what we would end up with is base rate coming down, swap rates coming down, the market settling into a lower rate, which would be better for my sort of monthly mortgage repayments. And then we had the crisis kick off in the Middle East, which obviously has a huge impact on global energy supply and supply of sort of important materials through the global economy, which means that will have an upward pressure on prices for everything, for the things that we kind of use to drive that global economy. And so where I find myself is I am now 5 months out, 4.5 months out from my remortgage date, and you can start looking for a new mortgage deal from about 6 months out. So, having put it off for probably a month too long, I decided to first redo the family budget. So it's like, okay, what have we got in our disposal? As we said before, income is your biggest asset. And I was looking at what our income looks like, how that fits in with our expenditure. So I did a really tight budget and then looked at it and thought, actually, I feel a lot better about what we can do. There's plenty of things, money there for us to do what we want to do kind of thing, but it does need to be managed carefully. The next thing I did, because I'm quite a catastrophic planner, Ed, was I looked at how high mortgage rates had to go before I really started to worry kind of thing. Where would they need to go? And even with a few hikes in mortgage rates in the wrong direction higher, I felt like the monthly repayments would be fine. So now it's just a case of what's the best deal going to look like. Contacted a mortgage advisor and they have come back with a recommendation, 2 recommendations. So I can either, and it depends, I suppose it boils down to my own sort of comfort level. And this is what Tanya, my wife, and I are grappling with at the moment. So one is ever so slightly higher than what I'm paying at the moment on a 2-year fix. So I'm talking about 0.01% higher. So basically the same. Or get a tracker mortgage. So for those who don't know, a tracker mortgage tracks the Bank of England base rate. So it's not exactly the same as the Bank of England base rate. They add some percentage points on top of that rate to make sure that obviously it's profitable for the lender and that they're covering themselves. But that was about 0.8% cheaper than my current fixed rate, and therefore obviously would be cheaper than the 2-year fix that we could potentially go with. So the thing that's put me off at the idea of doing a 2-year tracker in the past is I'm going to be locked in for 2 years, and who knows what's going to happen in 2 years. I could win, i.e. the base rate could come down, all these inflationary pressures could dissipate, and what we end up with is me paying a much cheaper rate than before, or it could go the other way, right? And I could end up paying higher than what I'm paying at the moment if we see a series of hikes. So I'm stuck in the middle of this thing because an important thing to point out is I was wrong. I thought I would be tied into that 2-year tracker, but actually it turns out you can leave those deals at any time. So the question that I've been wrestling with is how many base rate hikes do I think there will be over the next 2 years? Because at 0.8% lower than my current fixed rate, I would need 3.25 increases in the Bank of England base rate to reach what I'd be paying anyway. And actually, if you think about the sort of wider economy where we sit now, I'm not sure that we'll get more than that just because of the pressure that would put onto the UK economy, which grew slightly last month, but actually is still somewhat flat. And what they don't want to do is tip us into recession and potential for unemployment. But having said all of that, the uncertainty around everything is so huge at the moment where anything could happen, right? So the sort of cautious person in me is just hedge your bets and just take the rate that's about the same as now and ride it out for another 2 years. You've shown that you can afford it and you can continue to do the things that you want to do. But then there's a little bit of me, which is where you might miss out on some upside in terms of downside in terms of the rate, but upside in terms of my monthly income. And that could be put to work in my pension in other places. So it's a tough decision, Ed.
Okay, first off, I'm going to say I'm really interested for anybody following along who's maybe in a similar position, has been in this kind of position. I'm really interested to hear your views about it, whether you've decided to fix, whether you went on to a longer fix, whether you've opted for a tracker, if you've even spoken to mortgage brokers who've given you advice. Now, obviously, we don't provide financial advice on this podcast. We just talk about the issues. We really recommend you do speak to a professional if you are in this kind of position, you're not quite and you're not sure what to do. Highly recommend all. Even in normal circumstances when remortgaging or getting a mortgage for the first time, it's generally speaking a good idea to do it through a broker. A lot of them don't even charge for it because they will basically get a fee from the mortgage provider, although it does vary, so make sure that you're aware of that. Now, Chris, now you've explained it to me, I have views.
Okay, I want to hear them. We're in the council stage now, Tanya and I.
Yeah. Okay, so the fix that you've been offered here is only very slightly higher than what you're currently on, and you're already capable of doing that. Do you know the actual cash difference between the two?
Yeah, I do. It's about £25 a month.
Okay, that's not a huge amount of money.
Not for a mortgage, no.
Yeah. So look, what we're talking about here is we're talking about whether you want certainty or whether you want to effectively, and I'm going to be really blunt here, whether you want to roll the dice, because that is what going onto a tracker is. You are rolling the dice that basically better deals are going to come along in 3 months' time. I would personally, if I were in your situation, and I'm potentially going to be in this situation next year, I think that's quite perfectly possible based on what I'm about to say next, I would book the 2-year fix. For £25 a month more, for me, that feels like a no-brainer. And I'll tell you why. If you're looking at what is going on, okay, obviously we've got Middle East crisis. That's a big issue. It's creating inflation, petrol pump prices, energy prices, all sorts of stuff feeding into that doesn't look good for the UK economy. But it's very uncertain about how much of an impact that's going to have. I think even the worst projections, not really predicting what happened in 2022, 23, we're not going back to that level. It will probably have some of an effect, and that will push interest rates somewhat higher, but not crazily higher. So the gamble is, do I just wait and see and hopefully this stuff all feeds out and then we don't have an issue? For me, the big problem you have now is a very UK specific problem, actually.
Okay.
It's not something that coming into this chat that I thought I was going to have to mention, but I did realize that is that we have real political uncertainty right now. Mm-hmm. If you look at what is happening in government, with all the uncertainty in the Labour Party, with potential, we've got by-election, we've got potential leadership contest. If you look at what the bond market is doing, the bond market, which we're not here to have a discussion about what the bond market means for the government today, but what the bond market does have an effect on is mortgage swap rates. It does have a really important impact on that. If we are in for a period now of prolonged political uncertainty, call it even 6 months to get to the end of a leadership contest, then potentially unpopular with the bond market doesn't like their policies, then I think the gamble on a tracker, for me, I wouldn't take that gamble. I just wouldn't. I would just fix. The tracker is just, you're giving yourself certainty. You're saying, I'm not going to play this game. I'm just sitting it out.
Sorry, the fix, you mean? You said tracker. Do you mean fix?
Yeah. Apologies. The fix. The fix is, I'm not playing this game. I'm not going to roll the dice. I'm going to fix. Then I know what I've got and I just sit with that. And frankly, for £25 a month extra, you're just basically paying a bit of a premium for a couple more years of peace of mind. And we've had this discussion before. Why are we in the perma crisis? Why is this stuff constantly roiling us? The thing is, right, is this is a more general point because I can't speak to your specific situation, but with a mortgage, the idea is when you take a long-term fix, theoretically, somebody takes that fix and then gets a pay rise every year. Now, obviously, on an individual level, that's not necessarily the case, but generally speaking, people should get pay rises. Your mortgage actually becomes a bit cheaper every year because it just stays at that same level. And that's, you're arbitraging your income, which, as you said, is your biggest asset to earn, against that fixed mortgage, the cost of which should basically effectively be diminishing with inflation over time, as long as your rate isn't absolutely disproportionate. I don't think that's my thinking on it would be is just fix. It's not worth the worry.
Let me counter that, Ed, with
okay.
And this is, money's an emotional decision, right? And I don't disagree with what you just said. And that has been largely my approach the whole time I've been managing this mortgage, right? It's a huge debt. It's a massive undertaking. I'm conscious of the size of it, how important it is. And you have to steward this debt through all sorts of stormy seas and make sure that you're able to manage whatever life kind of throws at you. That uncertainty is obviously the big reason here, or the big factor that needs to be considered, right? And I haven't really thought about the UK political situation, but you make a really good point. I have been following news updates in the Middle East with trepidation, even as I look at it now, because you're like, hang on a second, anything can happen, right? That spiraled to a point where it's under control now, but that could flare up even worse at any moment, which who knows what impact that could have on the global economy, right? So that's been my major source of, that's going to have a major impact on inflation globally. However, and Tanya and I have talked about this, we haven't really got lucky with the rates, right? So we've always been slightly more expensive than you sat on here and said, oh, I fixed for 5 years on a good rate and I feel good about it. We've not really had that experience just because of the cycles we had. When we first bought our first flat, I think we were up about 5% when everything was down about 2% because of a situation there. And when I spoke to this advisor, he ran sort of soft checks on our income. Our affordability is great. Our loan to value is, I think you have to be under 60% to get the best possible rates. We'll probably be close to that when we get to the end of our current next mortgage, the next 2 years or a little bit after that. We're paying this all down really. Credit score's good. Everything's where it needs to be. There's a feeling in the house that actually it's about time we got a little bit of luck with some of this kind of thing. And that's the emotional pull against this, which is, let's just play a different game, right? We book this rate. October rolls around. We roll onto it because things change. And then in January, you and I are having another discussion about how my mortgage rate is painful. And that is what's nagging at the back of our minds. And also the practicalities of booking the mortgage now. So I think the argument is, look, you can book a rate now and just have that as your base, right? That's just your floor basement rate. So you're not going to go any worse than that, or the other way, so your ceiling. And then we can hop onto another one between now and October, depending on what's going on. However, listen, I think with me, the kind of cautious side of me with debt always wins out. And I think, is it manageable? Is this the going to fit in with my monthly income? And having done the sums and cut back on a couple of bits of that lifestyle inflation we talked about, cancelling some pay TV and all that kind of thing, it will, and we'll be able to do all the other things that we want to do. So I'm leaning towards the 2-year fix as well. But I tell you what, I've never watched global events and mortgage rates closer than I will in the next 5 months.
So this idea of getting lucky with things, I think is really interesting. I would say that you should never, ever try and consider yourself unlucky or try and say, we haven't gotten lucky yet. I think if you wait to get lucky, you are always going to be disappointed. I think you have to make decisions and take things into your own hands. You have to, and sorry to keep using the kind of, we appreciate we're using this kind of like casino metaphors today, but you've got to play
the best one, is it?
No, it's not fantastic for a money podcast, but you've got to play the hand you're dealt. Yeah. And I think having a mindset of, oh, we've just been really unlucky is just, I think you got to expunge that from your mindset, Chris. I'm sorry. I'm going to be really honest here.
No,
I think,
to be honest, Ed, I have really when push
Yeah.
comes to shove. But money's an emotional decision, particularly for me, and I've talked before about this in the past. So I think I need to get comfortable with that before I actually put the ink down on the paper. And I'm being chased by the mortgage broker at the moment. Literally, I've just had a ping while we're on here going, "What are we doing?" You know?
yeah,
And it's like,
I would just take the certainty every time, personally. And the thing I would do in your position is I would lock in that rate today, personally. I would lock it in. And then the next step I would do is I would say to myself, what can I do to free up income, extra income? Because I know you've got a relatively healthy rainy day fund, because we've discussed it lots. So what extra income can I set aside now? And actually, if the mortgages thing, the thing that's really making me unhappy and the uncertainty with their mortgage, then what you need to do is overpay and actually get some of it, like scrub more of it out. You said you're going to be, by the end of the 2 year, you're going to be under that 60% LTV threshold.
Maybe, I don't know. I'd have to look at that, but it'll be there or thereabouts.
Okay.
Yeah.
If you get more of that income and set it aside to overpay, you can push yourself below that 60%. And then in 2 years, you say to yourself, I'm always going to get the best rates because my LTV is now better, because we pushed hard for a bit to get under there, to push it under there ourselves, not wait around to get lucky on the rate, but actually force it lower, push it lower. That would be my message to you here.
Yeah,
Chris.
no, listen, I don't disagree, like I said, but it's good to talk it out loud with somebody else and on this pod, which is what we do. But I think, listen, the luck thing's a bit silly, but it's irrational, right? Money can be irrational sometimes, and that's not the way I've approached this. I think in the past, it's always been a case of what's the best rate available, the certainty that I want, blah, 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 blah. I think we got stung a little bit with that first ever mortgage rate. I fixed it for 5 years because it was way below any rent that either of us were paying. And that's actually a different lens of looking at this. Well, that rate seems high, but actually we're spending like 300 quid less a month than we were on our rent before, and we're able to save and do all those kind of things. I think the other big thing, Ed, and being really candid about the rainy day fund, is it's there for a reason. I'm concerned, okay, I need to be prepared for, have that kind of fund ready to, war chest ready to attack those things if they do come to fruition. But actually the big thing for me was doing that budget. So I sat down on a Saturday, finest tooth comb you can ever imagine. And non-negotiable for me was, am I still able to save? And even if it's only just a little bit, it's a threshold. If there isn't enough discretionary income at the end of the month to be able to save, then we have to really look at reducing costs. So that's into the pension, into the children's JISAs, but also back into that rainy day fund. So that's something that's a weird quirk of me, which is that needs to be going up, right? And then we'll look at maybe investing that when we reach a certain size, maybe, and see where we go with that sort of thing. So once I've done that budget, I'm largely calm now with either rate. The question now is, okay, or either approach, sorry. The question then is, like you said, do I want to be waking up in 3 months' time, biting my nails, going, which way could this go? And actually, this has been quite a stressful process. It's a stressful process anyway, because you have to do a lot of midterm planning and make some hard decisions. But actually, it's been worse because of all that swirling uncertainty. So yeah, I'm kneeling down on the fixed side, but then there's two parties to this. And Tanya's a joint mortgage holder, and I need to talk to her about that. But I think we'll probably go for that. And the other thing is, we've got 5 months to wait and see. And the other thing I'll say as well, Ed, is it's 4 months until my current lender, Santander, offers me their rates. So they only become available 4 months before. So in a couple of weeks' time, I'll be able to see what they're offering too. So it's not a case of fix and then it's done. It's fix. This is the worst it could be. And then it's what else could happen in the interim. And then it might turn out, if things move, it's the best it could be, right? It's just being aware of that.
I think their saving point is that long-term saving point is really important. And we've discussed this before. When we had Janesh from Sprive on talking about overpaying your mortgage. Like, obviously, paying into the kids' junior ISA is really important. Paying into your pension is important. Paying into your ISA is important. All those things. I think it's worth thinking about that. Can we overpay that mortgage? Because there is a long-term benefit to that, because aside from anything else, you got to think about, when I'm old, I don't want to be paying a mortgage, or I don't want my kids to have to help me because I can't work anymore. I might need more help. All that kind of thing I think is really important.
Well, on that, Ed, I mean, it's 72 is when I will be, according to, so I've said on previous pods, it needs to be overpaid at some point. And if we overpay at the top, the front end of the loan, it's going to reduce the interest repayments, as we touched on with Sprive. So it is a bit of a no-brainer, and maybe redirecting some of that instead of into investment markets might be the way to go. It's a decision to be made once the dust settles on this decision, I think. But yeah, it's a really good point.
The other thing I'd mention about your point there about the kind of, you're going to get your current lender's rates come available to you in the current week, is, again, by-election is coming up in probably 6 weeks' time. So do you want to be looking at do you want to be making a decision in 3 weeks when we've got a chaotic political...
No, I suppose what I'm saying is, if I book this rate now, and they come up with something materially cheaper, and it's a product transfer, which
Yeah,
means
'cause
there's no affordability checks or anything else like that. Let's do that.
That's
Let's put that
the
one.
really important thing, isn't it? Because you can lock in the rate now and then sit on it and wait and see what actually is happening when you actually have to make a decision before
Exactly
the remortgage happens in a few months' time. So lock it in now, maybe, and then bin it off if things get better before you actually have to sign on the dotted line, kind of thing.
Which is why I started this process already. It's why I started it 5.5 months out, because we've got to work with today, and we'll see what it's like in 5 months' time. But again, it's interesting. I'm glad you lampooned it a bit, but that emotional aspect to it, that, oh, for God's sake, it's got a 4 in front of it again, blah, blah, blah. And I was banking on it having a 3. There is a bit of a journey you have to go on now. We have to make peace with it. Let's start that process now.
We're going to have that next year because we got a 5-year fix in 2022 on a rate that's sub 3%. It was amazing, really good. That's ending next year, and I'm never going to get it back. There's an emotional, psychological, I think it's actually even behavioral anchoring there. When we have one good thing like that, as soon as you see the new thing, it's, oh God, this is a nightmare. And you're given to negativity about that because it is negative. It's not good. But you can't remain anchored on that position. You have to look at the here and now and what I can do. Listen, I'm really interested to hear from people who follow along today. What are your thoughts on remortgage at the moment? Are you going through the process? Is it something that's a bit further on the horizon? Are you sitting on, I'd love to hear from somebody who's sitting on a 10-year fix and is just, I'm completely out of this. I'm the biggest.
I've heard these anecdotally, Ed. I've heard these anecdotally. I heard someone mentioned they missed out on one or 2 years ago and they were kicking themselves.
Really interested to hear from people about it. So do let us know in the comments. We try to respond to comments. We try to keep the conversation going. Please give us a like and a subscribe and a follow. Really helps the channel. With that, Chris, I shall say good luck with your choices.
Update to follow, listeners. I'll let you know how we get on, but decisions being made.
We'll have another chat very soon about it, hopefully see what's happened. Thank you, everybody, for listening. We shall speak to you all again very soon. Thank you and goodbye.